Hello everyone, welcome to another episode of our knowledge series organized by PMS Bazaar. To introduce myself, I'm Pallavarajan representing PMS Bazaar and I'll be your host for the day. Today's webinar title is Wealth Creation for the Next Decade with Growth Investing, and to present that we have a special young and dynamic guest, Mr. Amit Jeswani, who is the founder and CEO of Stallion Asset. Before I hand over the floor, let me give a quick introduction about Mr. Amit. Mr. Amit Jeswani is a graduate in business with finance from Kingston University London. Hailing from the family of stockbroker, it was quite natural and easy for Mr. Amit Jeswani to experience the equity investing from his tender age of 16. Thus, by learning the nuances of the investment early and combining with the double charter knowledge, Mr. Amit Jeswani started Stallion Asset as a research analyst company. The ever increasing levels of trust of his clients made Mr. Amit Jeswani to scale up the Stallion Asset into portfolio management company. And Amit is CFA and CMT. It is very rare combination to get a fund manager who are expertise in both fundamental as well as technical. So with that note, would like to hand over the floor to Mr. Amit. Amit, over to you.
Thank you so much for your kind introduction, Pallavji. Thank you, everyone. Good evening. Thank you so much for joining us. Thank you, PMS Bazaar, and thank you so much, everyone, for joining us this evening, today. So let me just start. First, a small disclaimer. I hope everyone's safe. Everyone's doing fine. We in Mumbai are doing fine. Of course, with rising cases, it's getting a tad bit tougher, but it's still very good. First of all, disclaimer, as Pallavji said, Stallion Asset, it's got two lines of business. It's got a research analyst desk and a PMS desk. And every stock that we speak about is just for example. This is just for education purpose. Please do not take that as investment advice. Please do consult your advisors before you make any decision. Getting to the most important parts about us. So as Pallavji kindly introduced me, I'm Amit Jeswani, and I'm the founder of Stallion Asset. I'm a CFA and a CMT. I graduated from Kingston University. You see the office on the right, that's how we started. We started really small, 8-9 years back. We started as a research firm. There are about 3,000 odd research firms in the country. We were probably the only few ones who went from being a research desk to being a PMS. The PMS, and the only one reason this happened is because we created value for our customers consistently. So that's what we didn't come here by a parachute. We came here by creating value for our customers. Performance, this is probably the most important part. In 2018, October, we became a PMS. In the first full year, that is 2019, we were up broadly 27% net of fees against 5-6% for the benchmark, beating the benchmark by about 22% net of fees. That was the first year for us. PMS Bazaar was kind enough. It gave us the best performing fund award for that year. Now, in the second year, that is 2020, our portfolio was up 41%. Net of fees. Again, we were one of the better performing funds in the country. So that's what our journey has been. The first question a lot of people ask me that, Amit, you might have taken a lot of risk to deliver these kind of returns. The answer that I typically tell my customers, my prospective customers, is no. In fact, our portfolio beta, which is the measure of risk, is 0.82. which is 18% lower than the benchmark. Our return since inception has been about 34.5% CAGR, but we didn't take a lot of risk. In fact, we've taken 18% lower risk than the benchmark. Our standard deviation is also lower compared to the benchmark. So we did high returns, we did lower risk. even in the drawdowns in the first quarter of 2020, that is from January 1st to 31st March 2020, where the markets were down about 32%, our portfolio was down 18.5% net of fees. So even in bad times, our drawdowns were actually lower. As you see the chart on your screen, we probably made a new high in June, July itself. So our portfolio made a new high in June, July itself. So how do we do that? What do we do for our customers, and how this kind of investing will help you for next decade? So first of all, our goal, a 1 crore portfolio, if you invest in, let's say, an FD, which compounds at 5%, your FD in 10-year period will be 1.63 crores. So that will be your FD kind of returns in a 10-year period. At 10%, 8 to 10%, that's what people expect returns from, let's say, a gold, which is an inflation hedge. If you invest in something like gold, in next 10 years, your investing returns would be somewhere around, your 1 crore today should be anywhere between 2.16 to 2.59 crore. If you compound capital at 15%, your 1 crore will be 4 crores. If you compound capital at 25%, your 1 crore would be 9.31 crores. If just in case you're very smart and you can compound capital at 35% CAGR for the next 10 years, your 1 crore today would be 20.11 crore. Our goals at Stallion, of course, this is not a guarantee, is to compound capital at 18 to 25%. So those are our goals, compounding your capital consistently at 18 to 25% without taking risks higher than the benchmark. So we calculate risk by our portfolio beta. Portfolio beta explains how much volatility you have in the portfolio. So that's our goal. My customers would be very, very happy. Of course, this is not a guarantee if their 1 crore becomes anywhere between 5 to 9 crores in 10 years from today. So what works in history? So I've given you 1 decade of this is probably the most important slide in this whole presentation. This is something that we work on very aggressively, backtesting what works, what doesn't work in markets. So if you see the character of companies who did bad performance, basically, I'm looking at this chart. Unfortunately, you will not be able to see this chart, the right-hand side chart, because there are video columns here. But if you look at the left-hand side chart, the investment CAGR, this is the 9-10-year period. We've not taken FY20 as the ending period because FY20 numbers were not coming right due to the corona provisions and everything. So if you wanted less than 0% returns for last 10 years, you had to invest in companies on average that had an EPS CAGR of 35% negative. If you wanted 0 to 20% returns, all you had to do, find companies where EPS CAGR on average is 7-8%. If you wanted 20 to 40% returns, your EPS CAGR expected was 18%. At 40 to 60, it was 23% EPS CAGR. I've taken ROCE as well. If you see properly, as your EPS CAGR is high, so is your ROCEs. So on average, high ROC, high growth delivers very high returns for market participants. So in this 10-year period, 9-year period, which we've taken as a sample, the Nifty EPS CAGR was 7%, and companies which did better than Nifty really performed very, very well. So this is probably a good backtesting chart that market rewards growth. Stock performance is dependent on EPS growth and capital efficiency. I'm sure you can't see the chart on the right, but even if we take the last 5-year returns, the exact same things come. Higher the growth, higher the returns. Over long periods of time, the only 2 important things that you have to look at while investing, because we're speaking about investing for the next decade, is your EPS CAGR. See how beautifully on the left-hand side, for higher returns, you need higher EPS growth. So stock performance is, of course, over long periods of time, dependent on EPS growth and capital efficiencies. The opportunity size, competitive advantage, quality of management, capital allocation decides the growth rate in EPS and hence the stock returns. Moving to the next slide, we will be speaking about growth investing throughout. So where do we invest for the next decade? So in order to get 18 to 25% CAGR, which is our goal, which I spoke about in the first few slides, it is very important that we invest in companies that grow at 18 to 25% for next decade. Market rewards sustainable, secular, predictable, durable growth in businesses. You don't want cyclical kind of growth where the company grows 2-3 quarters and then degrows for the next 3 quarters. That will cause stock volatility. Odds are you will lose a lot of money doing that. Now, about the macro picture, India is at $3 trillion GDP today. If we grow at 5% for next 1 decade, we will be a $5 trillion economy. If we grow at 7%, we'll be a 9%, like the best case scenario will be a $7 trillion economy. So India in the next 10 years will be anywhere between a $5 trillion economy and a $7 trillion economy. For a business to grow, there are only 4 things that is possible for any business to grow. Increase in volume of whatever product they sell, increase in price of the product, entering new products, or acquiring other companies. Those are the only 4 possible ways for a business to grow. We believe this is for Stallion, and we are very, very, very confident in what we are saying in this slide. Consumer, financial, technology, and pharma, only these 4 sectors will create the largest market cap for next decade and next many decades to come. So we at Stallion do not typically invest in government companies. We at Stallion do not invest in cyclical stocks. We don't do high debt kind of investing. All that we don't do. In our opinion, the largest wealth creation will happen in these 4 segments: consumer, pharma, technology, and financials. If you think about it, consumer and pharma are defensive in nature, and they do well in bad economic cycles, whereas financials and technologies where the hyperscales or the large scale up happens. So why do these 4 sectors? The opportunity size in all these 4 sectors in India is massive. The business model in all these 4 sectors are secular and typically get better with size. Think about it. If you're opening an account, odds are you'll open with an HDFC bank. Because it's a larger bank, it's got many branches, it's got all the services that you need. You will not go and open an account with a very small bank, which got, let's say, listed today, Suryoda Bank. Odds are that you will not open a bank account. So the business, the bigger it gets, you will give low-cost deposits to an HDFC bank at 4%, 3%, FDs at 5%, whereas smaller banks will take money at 7%, 8%. Think about it. They can lend it at 9%. Like HDFC can borrow at 5% and lend it at 9% and still be very profitable. But for a Suryoda or any new bank who's lending at 8%, to get the 4% margin, they will have to lend at 12%. So basically, they will have to do subprime kind of lending to get exactly the same returns. So typically, that's the same case with technology. We are all on Facebook because our friends are on Facebook. The bigger Mark Zuckerberg makes WhatsApp, the better it gets. Similar is with Androids, where all or YouTube or all these consumer technology companies typically get better with size, do not get worse with size. Pharma companies, the more larger you get, let's say in diagnostic chains, the larger you get, the better it is. People start trusting your brand a lot more. In hospitals, you will not trust one single hospital, but when you have a large hospital chain, people typically trust you a lot more. You get benefits of doctors taking lesser salaries, etc. Similar is in consumer, especially retail. So in all these 4 businesses, broadly, the bigger the business gets, it typically gets better. That's not the case in cyclical kind of businesses. Majority of our portfolio is into B2C facing companies. We avoid, there are 4 kinds of businesses: business to consumer, business to government, government to business, and business to business. So there are only 4 kinds of businesses. Typically, a large percentage of our portfolio is in B2C companies. As I said, we don't do B2G or G2B. So no government in business. Government, as Modi ji said, should not be in business, and their role is for better social things and not to make money for minority shareholders like us. They don't care if we get if the stock price goes higher or lower. If they are not interested in creating market caps. Though very small percentage of our portfolio is there in B2B companies as well, but we typically buy B2B companies only if they are hyperscalers with a massive competitive advantage. That is very, very, very important. So what do we want in our companies to have? What are the typical kind of companies that we want to invest in for next decade? There are 4 kinds of businesses, and this is to do with market opportunity. A shark in an ocean. These are leaders in large opportunity size. Since I spoke about HDFC Bank, it's an easy example. I'm not disclosing my stock, so I'm trying to give you easier examples. Way back 20 years back, HDFC's loan book size was 10,000 crores. The total Indian banking size was 5 lakh crores. So HDFC was 10,000 crores. India's bank was, all Indian banks combined, was 5 lakh crores. The opportunity itself was growing. So the Indian banking system today stands at about 100 lakh crores. HDFC's balance sheet size has moved to about 12 lakh crores. So HDFC Bank has grown. It was a shark in an ocean way back in 2000 as well. Basically in a growing opportunity, it was the market leader. I can tell you, sharks in an ocean is where the largest market cap creation happens, when you have a leader and the opportunity size is very, very, very large. That's where, see, think about it. A Maruti can only grow as much as the Indian market, assuming Tesla doesn't disrupt it. So Maruti will, assuming Maruti has 50% market share, Maruti can only grow at 10-12% based on the opportunity size. Something like a D-Mart. I'm just giving you this as an example. The total revenue of D-Mart is 25,000 crores. The total retail market in India is about 50 lakh crores. Every year, the Indian retail market grows at 10-15%. Broadly adding 5 to 7 lakh crores of new retail business gets created. So many D-Marts get created in 1 year. The one with the lowest cost is D-Mart. Globally, we've seen a large wealth creation happen in discount retail, but winners have only one thing in common. The one with the lowest cost always wins. The D-Mart operating cost structure. So I'll just give you an example. Walmart in the US has 4,700 stores. Tesco in the UK has 3,900 stores. The population of US is 32 crore people. The population of UK is 6 crore people. And Tesco in the UK has 3,900 stores. D-Mart in India, whose population is 130 crores, has about 220 stores. So you have a large opportunity size. All they have to do is exactly do the same business for next many, many, many years. So this is an example of a shark in an ocean. Shark in a pond. There are many businesses here which I can speak about. Let's take Reliance in the refinery business. It's a leader of refinery in India, but the opportunity size for it to grow is not there, and hence Reliance had to diversify into other large oceans like the telecom plus technology kind of business. A fish in an ocean. These are small businesses which have a large opportunity size to grow. Let's take an example of AU Small Finance Bank, where the bet is on the promoter. This is an example of Sanjay Agarwal, probably trying to scale up. And this is an example of a fish in an ocean. If he does well for next 5-10 years, assuming the India credit market grows at 12-15%, if India has to grow at 6-7%, lending in India has to grow at 12-14% at least. It's not impossible for economy to grow without lenders growing. If India has to grow at 7%, banks will have to grow. Banks on average will have to grow at 12-14%, and smaller banks like AU, who have got good managements, can grow at 25%. Well, I'm just giving you an example. So this is an example of a fish in an ocean. The fourth kind of businesses, these are the worst kind of businesses, and I strongly recommend you never invest here, is a fish in a pond. Basically, these are small businesses and small opportunity sizes. We clearly want to invest in shark in an ocean, or sometimes in a fish in an ocean. Management. There are only two key roles, according to us at Stallion, that managements do. One is capital allocation. Where do I, whatever operating cash flows I'm generating, where do I invest that? And the second most important role is capital distribution. And that is especially important for asset-light compounders, companies who don't need capital to grow. They need to do capital distribution. And that is basically, if you hoard cash on your balance sheet, you are reinvesting that money in FDs at 5%, which destroys value for shareholders. The three key S's for management, according to us, is speed, scale, sustainability. How fast can I grow? How much can I grow? And how can I grow sustainability? Those are the three key decisions that managements have to take. Companies who do that successfully typically end up becoming large wealth creators. Emerging monopolies or proven monopolies. These are the only two kinds of businesses that we want to invest in. There is nothing worse than, so what's the difference between an emerging monopoly and a proven monopoly? A proven monopolies are typically companies in the mature side of the business that grow at 15%, 10, 15, 18%. Let's say an HDFC, which is on the mature side, grows at 20%. Something like a HUL, which is on the lower side of maturing. It is more mature, grows at somewhere like 9% or 8% or 10%, or a Nestle grows at 8-9%. So those are the kind of businesses which are proven monopolies. These deliver decent returns as well. So what's the difference? The emerging monopolies are companies who are in the newer segments, and there are places where there is hyperscaling happening. That is where large wealth creation happens. But all these hyperscalers need to be market leaders as well. Think about it, the last decade as well, if you look at large wealth creators, something like a Bajaj Finance or a Astral Poly, had got CPVC from Lubrizol, the technology of CPVC, something like a Symphony, which was a very large wealth creator. Again, it was a market leader in the cooler segment, having more than 50% market share, something like a La Opala, who has 50-60%. So those were hyperscaling at that point of time. Something like a Serra was growing at 40-50%. That decade, something like an Avanti. They were all market leaders growing at very high speed. They were small in size, large in opportunity, and they already had the unit economics right for them. A business, according to us, large market cap creation happens only in monopolies. There is nothing worse than competition in business. A monopoly is the only condition for every successful business. This is what we strongly believe, and this is where we invest in. Every business starts with solving a problem. Every business succeeds when it can make sure that it is the only one who's solving that problem, basically creating a monopoly. Large profit pool. If you see in India or across the world, to be honest, there are only a few players who dominate profit pools. This is the same in India. This is the same across the world. You take any segments, you will have very few players having that whole profit pool. Entrepreneurs' dilemma. We speak to a lot of entrepreneurs, and entrepreneurs tell us that you know what, this is a 10,000 crore opportunity, and I want to have 1% market share. If I have 1% market share, I will do 100 crores of revenues and about 10-15 crores of profits. Well, this is one of the biggest mistakes what entrepreneurs make. In my opinion, if you want to do 100 crore revenue, do it in a 200 crore business size. So once you basically you dominate small niches in a 200 crore opportunity size, if you do 100 crore revenues, it becomes very difficult for competition to come and beat you, because you are broadly 50% market share, and becomes impossible for you for competition to come easily, because you get a lot of different kind of advantages which help you. Margin of safety. How do we value companies? The value of a company is equal to the steady state value plus future value creation plus excess cash minus debt. I know this sounds complex, but I'll just tell you how do we at Stallion look at valuations. In my opinion, this is This is different from the P kind of ways, which majority of people follow. We look at how much capital a business generates. That is the operating cash flow. What percentage of this capital gets reinvested into the ROIC, the rate at which it's getting reinvested, minus cost of capital into competitive advantage period. How long can a business, I'll just give you an example in 1 minute, but how long can a business reinvest all its cash flows? And so that basically tells you a lot about the scaling up divided by cost of capital. One very important thing I'll tell you here, I'll give you an example of a farmer. If a farmer has 100 rupees cash today, and let's say the farmer buys a land worth 100 rupees, assuming the farmer is, the ROIC of the farmer is 33% or 33%, that means in year 1, the farmer will make 33 rupees. Year 2, the farmer will make 33 rupees. Year 3, he'll make 33 rupees. At the end of year 3, he's getting the 100 rupees back. The farmer goes and buys one more land. So basically, so at 100 rupees, he bought one more land, assuming his ROICs remain at 33%. The cash flow in year 4 will be 33 rupees from the old farm and 33 rupees from the new farm. In year 4.5, he'll get 16 year in farm A and farm B. Basically, in year 4.5, he can go out and buy a third plant. So basically, what the farmer is doing is reinvesting all his cash flows, whatever he's generating, at 33% ROICs. And as long as he can do it, that will be a very, very, very good business model. Something like, so I will not take names here, but assuming there's one more farmer, let's say I am the second farmer, I'm not so smart, I'm investing capital at 12% ROIC. If that is the case, in year 1, I will make 12. Year 2, I'll make 12, 3, 4, 5, 6. It will take me 8 years to buy the second land. So the farmer A, the smarter one, bought the second land in 3 years. He bought the third land in the fourth and a half year. Here, the farmer B, who was reinvesting at 12% ROIC, bought the farm at the 8th year, the not so, the bad capital allocator. Now, there are some farmers who do not have the opportunity to deploy capital, assuming you're already very big in that industry. If you do not have the ability to deploy capital, then it becomes a problem, even if you have an ROIC of 33%, okay? Or let's say you have an ROIC of 40%. But if you cannot deploy capital and newer opportunities, all this farmer has to do is give back those cash flows to you. So those companies trade at dividend yields. And those are the asset-like compounders. You can make money there. But in my opinion, over long periods of time, you can only make money if the growth rate is very high, or else they are used as defensives in portfolios. But that's not where the wealth creation happens. The second most important thing, the margin of safety part for growth investing, what we do, market cap to opportunity size. What is the opportunity? What's the market cap? This works only for sharks in an ocean. Do not say there's a small company who's got like 1% market share and speaking about opportunity. No, that doesn't work. Typically, the company needs to be a leader already, and then we can speak about market cap to opportunity size. A lot of companies are valued at something like a Godrej Properties, who's got a market cap of 30,000 crores, is valued at market cap to opportunity. The opportunity size in top 5 cities where Godrej is there is 5 lakh crores every year of real estate sales. The market believes that Godrej Properties someday will grow its market share every year. As of today, the market share of Godrej Properties is about 3% every year of the total real estate basket. But the customers love the product. Only today in the press release, if you read Godrej Properties press release, in one day in Noida, he sold 5, on the day of the launch, in Noida, they have sold 500 crores worth of inventory just by showing photos. It's a good negative working capital cycle business to think about. The good part is they don't even loan the land. The land is owned by someone else. So that is how, that's why market gives valuation based on market cap to opportunity size. price follows fundamentals, but in financials, fundamentals follow price. Now, this is different. If you are a very expensive stock, so value investing, in my opinion, doesn't work in financials. In fact, you should find companies which are the most expensive on price to book. If you do an analysis of what high price to book companies have done in financials and low price to book companies have done, you'll know what I mean to say. I don't know why people do value investing in financials. It doesn't work. If you are trading at very high price to book, let's take an example of COVID times. Which are companies which bottomed at what price to book? HDFC Bank bottomed at 2.2 times price to book. Kotak Bank bottomed at 3.5 times price to book. AU Small Finance Bank bottomed at 3.6 times price to book. Bajaj Finance bottomed at 3.2 times price to book. SBI Cards bottomed at 10 times price to book. But you had, so basically that gives you the base worst case valuations, what the market will give even if a crisis like that comes. Try being an expensive kind of the banks which are making newer highs and not the ones which are falling down. PE and price to book only work when growth rate is less than cost of capital. A lot of people start with valuation as the first criteria for investing in a stock. While it's important, valuations are important, but more important thing is the quality of business, quality of management, capital allocation. You can be wrong on valuation, but think about it. Assuming I bought DMart at 80p and I'm wrong on valuation, but DMart is yet growing at 25%. In 3 years from today, DMart's P will be like 35-40x. And that time DMart will start looking cheap again. So I don't know, we don't know where, so basically growth is more important, but valuations typically work when growth rate is less than cost of capital. The way people value companies is cash flow into that's what we were all taught in school. Value of a stock is equal to the present value of future cash flows, and the perpetuity growth rate is cash flow into growth rate divided by cost of capital minus growth. If your growth rate is higher than the cost of capital for next many years, there is no way an Excel can calculate, and anything which is not calculatable, that's where big money is made. Madness of the crowd is overrated. Everyone says that crowds are mad. Wisdom of the crowd is underrated. I believe the crowds are smart. The crowd knows how to value stocks well. And that's why over sustained period of time, some companies trade at expensive valuations. And for the sustained period of time, some companies trade at not so high valuations. Deep value investing, in my opinion, works only in 3 places: Twitter, textbook, and WhatsApp groups. So deep value investing, we do not do. We do not believe big money can be made doing that. Consumer for next decade. So I'm going to speak about 4 sectors where we see large opportunity size and we believe large wealth creation will happen. I'm going to skip through this very fast so that we have some time for Q&A. Consumers for the next decade, if you look at organized retail, that is 1.5 lakh crores is what the organized retail is there, or total unorganized grocery retail kind of stores to 40 lakh crores kind of business. One of the lowest cost retailers does 25,000 crores of revenue. This is DMart. The opportunity size for next many years is massive. Walmart has done it. Aldi has done it. Walmart did 23 years of double-digit SSG. In the same period, the US economy went from 1.5 trillion to 6 trillion. So this is where large scale-ups will happen. QSR, it's a very favorite business of mine. The number of organized chain, the total market size of organized of restaurants, the QSR in India is 4 lakh crore. Organized is 10%. Okay, that is like 10%. Out of 4 lakh crores, only 40,000 crores is organized. The number of, let's take an example of Jubilant FoodWorks. This is just an example. The total sales of Jubilant FoodWorks is 4,000 crores. Jubilant FoodWorks, Domino's has 5 crore app downloads. Now people call for pizzas on the app. I'm not speaking about Zomato. This is Domino's own apps. They're getting into biryani. Yesterday they got Popeye. They're getting into Hong's Kitchen. So they want to, basically this again is a leader in a large opportunity size. The number of the revenues of McDonald's in the US alone is 3 lakh crores. Starbucks does 1.5 lakh crore. Domino's does 50,000 crores. Consumer electronics. So when you look about imports in India, there are 3 largest imports in India: crude oil, gold, electronics. These 3 are about 60-70% of India's imports. There are import substitute themes which will play, of course. The total market size of electronics in India is 4.5 lakh crores, mobile at 2.5 lakh crores, durables at 2 lakh crore. India sells about 60 lakh ACs in a year. This year, India will sell 60 lakh ACs. China sold 18 crore ACs this year. Just tells you the opportunity size in ACs or any other consumer durable in India. That is one large opportunity. Building materials. All these building material companies in India are either monopolies or oligopolies, and it's a winner takes all on the profit pool side as well. Think about paints, think about wires. You've got 2 key players or 3 key players in the country. One player doing about 9-10,000 crores of revenues, that is Polycab. You have Havells in the north who's doing 3,000 crores of sales, and then you have smaller players like KEI and all these guys. But the large profit pool is dominated by a few players. Be it steel tubes, where one player has 50-55% market share. Adhesives, where one player controls the entire market. Pipes, everyone's got their own regional monopolies. You've got ceramic players, where one player is the most profitable player among them all. Fashion retail, 4.5 lakh crore market. Fashion retail, 34% is organized, but I can tell you, fashion retail also depends. In my opinion, the ones who get into fast fashion, whatever we've learned globally, the one who can focus on very fast inventory churns, can control the entire supply chain, will win in this game. So we have seen, like, Zara controls the entire supply chain. Zara doesn't sell brands. He controls the entire supply chain. Max, which is an unlisted entity, controls the entire supply chain. So large supply chain controllers will win here, where the shop itself is a brand. So those are the kind of things that will, of course, fashion retail. You've got shoes, 220 crore shoes are sold in India, a very large opportunity size. Few large players will scale up here. So basically, on the retail side, fashion retail side, the ones who do very high SSG, same store growth, and the ones who scale up into new stores like Trent is scaling up on the Zudio side. The format is similar to a Primark in UK. So people who've been to UK, they'll know how Primark scales, how Primark sells. They're doing very well. Titan has 6% market share in the entire jewelry retail market. There is a massive consolidation happening in this space as well. Of course, one more player got listed today. That player does 10,000 crores of revenues. That is about 2% of the market. The total jewelry market in India is about 5 lakh crores. The organized players are taking market share every year. Every year you look at it, they're gaining market share. They grow at 20-odd%. Residential real estate, the listed, as I told you, 80% builders will go bankrupt. This is a good business model. It's just that there are a lot of dodgy promoters here. If we get decent promoters, this is one place where the profit pools are larger. Think about it. India's largest paint companies trades at a valuation of 2.5 lakh crores. Of course, not saying that it will not go higher. That is fair value for the stock. But something like in the real estate space, the largest, the most expensive real estate builder is at valuations of 30,000 crore. So the market size is massive for real estate in India. It's just that they need to have a more sustainable, predictable, consistent, scalable business model. If some real estate builders can do that in India, I believe large market cap creation can happen. But they need to have, they need to work on customer advances. They cannot be employing their own capital again and again. So the winning formula has been now where you have on one side commercial real estate and on the other side residential real estate. If you see, Oberoi is doing that. If you see Prestige is doing that, DLF is now doing that, where you keep annuities on one side, which keep giving you 1,000 crores or 500 crores every year. And that 500 crores is then invested in land to then be sold. So basically, every year you can keep purchasing land and then keep selling the properties. And now you've got subcontractors who construct the building. FMCG, well, the opportunity size is not very large in FMCG, I should say. It's a largely penetrated space. Everything is penetrated at 80%. It is very tough to find newer avenues to grow in FMCG. But one thing what I believe everyone's missing out on is the newer drivers of growth will be M&A in this section. If you saw what HUL did with Glaxo, HUL acquired Glaxo at 40p. The margins of Glaxo was, so you have distributors. Glaxo had distributors, his own people who were going in the street and selling Glaxo products, basically baby milk, milk powders, like HUL acquired Glaxo, and now HUL's people who are selling Dove or Lux also sell baby milk addition products, basically like Complan or yes. So that's where the margin increased from 25% to 35%. So if you keep acquiring, think about it. If HUL acquires Imami, I'm just giving you an example. If HUL acquires Imami, HUL's people will go and sell, the same person of HUL will go and sell Navratna Tel or Boroplus or etc., etc. So all HUL has to do now to grow is grow in the old business at 8% and then keep acquiring new brands. You have a very strong distribution, which is set. If Glaxo was, example, selling to 1 million 100 people, HUL, since the distribution is larger, will be able to sell 200, 300 people more, because just of the distribution reach, that is one side of growing. Now, on the more important side, where we believe there'll be hyper growth, is the financial side. The best competition in the world is the government of India. India's total financial credit market, the total loans that banks have given is 100 lakh crores. In the next 10 years, this will move to at least 300 to 400 lakh crores. That means the total growth of lending will be 12 to 15%. In my opinion, good banks should grow at 20%, 25%, 30%. Good banks will be able to hyperscale in this space, where 60% of the industry is still the government of India. The focus will shift from branch banking to technology banking. Your big is better. Don't try to do value investing here. Lending NBFCs, if the opportunity is large, someone will take this opportunity. The incremental opportunity is 300 or 200, 300 lakh crores in lending in India. So be it via credit card, be it via gold loan, be it via consumer credit. So consumer credit in China has been growing at 27%. Consumer credit for last 10 years. Consumer credit in US is growing at 18%. So even mature economies have very high growth in consumer credit. Buy now, pay later kind of business schemes will do extremely well for next 5 years. Consumer lending has done very, very well in India. That is one place where you can make large sums of money and retain it. We do not like corporate banking typically, and now these guys have databases. All these companies who have seen COVID crisis, they have database. That the people who never defaulted, even in the COVID crisis, when cities were shut for months and months, these people will never ever default. At least they will not be willful defaulters. So those people who have never defaulted, now you can, of course, give them more unsecured lending. Savings plus protection. Indians on total save 35 lakh crore every year. Yes, you got it right. 35 lakh crore is saved every year. 1 lakh crore goes to SIPs, SIPCRO, and 7.5 lakh crore goes to your life insurance companies. The rest, broadly 27 lakh crore goes either in real estate or bank FDs. So bank FD rates are now 5-6%. I do expect a decent migration in this part. You need to bet on better companies in life insurance as well. One player is 70% market share. And in my opinion, over the next 10 years, slowly, that player might start losing market share if it remains inefficient. Of course, the tough part is in life insurance globally, no one has ever made money. So, but that is also because of falling interest rates, and large percentage of people had given money on guarantee schemes, and the interest rates kept falling down. So, if in 1985 in the US, the interest rate was 15%. These insurance companies would tell that for next 30 years, I will give you 10% fixed rates. And sell their insurance schemes. Unfortunately, the interest rates came down and they didn't have avenues to reinvest capital. They lost money in their guarantee kind of schemes. General insurance, this is the most secular business. Warren Buffett also made money in Gecko. Warren Buffett's Graham, the guy who taught Warren Buffett, the father of value investing, Ben Graham, also made money in general insurance. In fact, if you remove one trade out of Ben Graham's portfolio, Ben Graham returns were negative for 20-year period. So that is how much money general insurance made for him in 1920s to 1940s, and then for Warren Buffett later on. General insurance is probably one of the most secular businesses in financials. The total size is 1.9 lakh crore. The largest player is 17,000 crores. 50% is PSUs, and PSUs, if they write 100 rupees of insurance, they typically lose 30 rupees on that. So fire insurance, car insurance, they're the world's worst insurers. They are going to lose market share. Private players here will win big. In my opinion, the industry typically grows at 12 to 15%. The next decade, we expect monopolies to be created in the financial services space with the use of technology. Fintech is one space where we are very bullish at Stallion. The biggest market cap in the US are not banks, to be honest, anymore. They are companies which are built on technology networks, companies like Visa, MasterCard, not the Goldmans and the Wells Fargos. So gone are the times of banks. It's all about technology going forward. Technology, I've kept this space blank. In my opinion, if you see in the US what has happened, the total market cap creation in the US over what has happened in the US will happen in India. There's a very strong correlation. The total market cap of US S&P 500 7-8 years back was about $12 trillion. $12 trillion. Today, the market cap of S&P 500 in the US is $32 trillion. It's gone from $12 trillion to $32 trillion. In that $20 trillion addition, $16 trillion has come from technology companies. Companies like MasterCard, Visa, Facebook, Apple, Google, Amazon, Microsoft, Netflix, Tesla, Shopify. I can keep going on and on. But believe me, the next 10 years, that will be the same in India. Majority of large market cap creation will happen in consumer technology companies. They will create large monopolies. The profit pools will keep expanding. They will get into from one monopoly, they'll shift to another monopoly, and they will keep getting better with size. We are just getting started on the consumer technology wave. This entire decade, in my humble opinion, if there is one space that will create the largest, well, that would be hyperscaling technology. Pharmaceuticals, this is, now we will be ending our slides. Pharmaceuticals, we've got diagnostics, 65,000 crore market. I will skip this slide. You have consumer pharma, which is a 1.5 lakh crore play in India. The big ones get better with size. Then you have, we do not believe generic business is a good business, but we do like the CRO, CDMO, space where the opportunity size is large. I'm so sorry, I'll have to skip this slide because we're running short on time. Small cap investing. Basically, there are small cap. India was a $1 trillion economy. So let me just spend 1 minute here. India was a $1 trillion economy in 2008. We're now a $3 trillion economy. The economy size, whatever we created till 2008, we've created 2 times more in the next 12 years, basically. We've gone from 1 trillion to 3 trillion, but how many small caps do you know have become large in the last 10, 12 years? very few small caps become mid caps. Market leadership is needed. So I spoke about companies like Sarah, Page, Relaxo, Symphony, Bajaj Finance. Once you're a market leader, so that is the most important thing, then you need a technological edge, something like a Paytm or a Zerodha, who's now become the market leader. You need, it was a small cap, it was not listed, but of course it was a small cap. You need either a technological edge, a change in business model, kind of things are needed for small caps to become mid caps. Remember, it needs, the small cap has to keep gaining market share. So it has to move from a 1-2% market share to a 5, 7, 10, 20, 30% kind of market share. And that is what creates large market cap. The only time we invest in, the only time to invest in small caps typically is when the sector is in trend, assuming today the sector in trend is chemicals. So the small caps of the chemical space will do well. If NBFC was the trend between 2013 to 2017, the small cap NBFCs were doing very well. There's a very large small cap rally which happens every 4 years. It has happened now in 2020-21. It happened in 2017. It happened in 2014. It happened in 2010. It happened in 2007. It happened in 2004. It happened in 2000. It happened in 1999, 2000, it happened in 1995, and it happened in 1992 during the Harshad Mehta bull market. So every 3-4 years, there's a large small cap bull market which happens, and then they go off to sleep. So you need to exit really well in small caps. Our portfolio risk approach, we are, I think, last 2 slides in it. We will try to finish as fast as possible. Sorry. The portfolio risk approach, remember, majority of our money would be invested in 4 sectors. 2 are low beta, consumer and pharma are low beta. And that is why when the market in the first quarter of FY20, basically CY20, from 1st January to 31st March 2020, during the Corona crisis, we fell less. We fell 18% against 30% for the market because our defensives were protecting us. Whereas on the upside, our financials and our consumer and our technology stocks typically do well. So we invest in these 4 sectors. Largest wealth creation happens in growth stocks, especially if you get low beta growth stocks. There's a difference between a Bajaj Finance growing at 25%. Bajaj Finance takes loan to grow at 25%, and a DMart growing at 25%. So assuming, I'll just tell you on our portfolio allocation things, if I have 8% weight in Bajaj Finance, 8% weight in DMart, assuming the market, so consumers typically underperform and the markets are on risk on mode. I'll just give you an example, a broad example. In October, November, December, January, February, March, February, Bajaj Finance would compound at 10% per month. Bajaj Finance went from 3,000 to, let's say, 4,500 till February. It basically would compound 10% every month. But that time, DMart was sleeping at 1,800. So automatically, my portfolio weights in Bajaj Finance would go from 8% to 11% because my consumer kind of stocks would not move. As soon as the weight would reach 11%, 10-11%, we would cut it down to 8%. Of course, since DMart was underperforming, DMart's weight would fall from 8% to 6%. We would change, we would sell our Bajaj Finance and reinvest that capital in DMart and make the weights of both these companies 8% again and again. The fall happened in Corona crisis happened, of course, and at one point, Bajaj Finance was trading cheaper than DMart. The price of DMart went to 2,500. Bajaj Finance fell to 24, it made a low of 1,800, but assuming at 24, 2,500, the weight of Bajaj Finance went down from 8% to 4%. DMart went higher because everyone was moving into defensive. The weight of DMart went to 11%. All we did, sold our DMart, bought in our Bajaj Finance. That's why these 4 sectors help us. Quality of growth, quality of growth. Type A, these are hyperscalers. There are 3 kinds of growth. The hyperscalers, this is how we define growth. The hyperscalers, these are high growth companies. You need to be careful here. they need to be market leaders, or they're not good hyperscalers. We don't do commodities and all that. The second kind of ones are the consistent compounders. These are mature businesses growing at 10 to 20%. That is where our allocations are. So our hyperscalers are emerging monopolies. Our non-hyperscalers are mature businesses which help us in bad times as well. Type C are the worst kind of companies where there is no quarterly trend. They grow for 2 quarters or 4 quarters and then they start degrowing. Those volatility we cannot take because we enter always at the worst time. And we exit also at the worst time in those cases. B2C trends are more consistent, and that is where capital protection happens. Hyperscalers like Page, Avanti, iSure, Bajaj Finance, I've already spoken about this. Given a choice at Stallion, given a choice of high risk, high return, and low risk, decent returns, we at Stallion will always choose low risk, decent returns. There are always going to be some people who will be getting richer faster than us. Greed is good, but envy kills. Our focus at Stallion would always is to get rich and stay rich. So we will always be lower. So growth investing is not about taking high risk. It's about managing your risk and keeping your betas even lower than the benchmark. So yes, there are about our portfolio risk approach. I'm so sorry, Pallabji, we are running very short on time, but this is my last slide, I promise you. There are always 4 risks we take while buying a stock: a business risk, management risk, valuation risk, or industry risk. I believe the intrinsic value of unethical management is 0. We do not want to be with bad management. Valuation risk we do take, but we want to be in good businesses, in high growth businesses. You can take valuation risk. If a business is growing at 10% and you're taking valuation risk, to me it makes no sense. There are 4 things which can happen. We are very strong on risk management. If there is one thing that we are very strong on, is risk management, and every growth investor has to be very strong in risk management. There are only 4 things which can happen in market: big profit whenever you take a position, big profit, big loss, small profit, small loss. If you can eliminate the big loss part, assuming you eliminate the big loss part, there are only 3 things which can happen in market: big profit, small profit, small loss. There is no bigger mistake. We do not hold on to our losers for a very long time. There is no bigger mistake in investing than holding on to your losers for a long time. Being wrong is acceptable. You will go wrong in markets, part of the game. Staying wrong is stupidity. We do cut our losers. Thank you, everyone. Thank you so much for patiently listening to me. I'm so sorry if I've been fast and I've skipped some slides, but that's okay. I never be able to finish my presentations on time. But yeah, thank you so much, Pallabji. Thank you.
Thank you, Amit. Thanks for your insight. I wish, as you shared in your initial slide, I wish you multiply wealth 5 to 10 times or even more for your investors for the next 10 years period as mentioned. So with that note, we'll move on to Q&A session. Unfortunately, we have very short time. As a process, we collect questions during the registration, and there are a couple of questions which have been lined up in the floor as well. What we'll do is that we'll try to take 2 to 3 questions, but I promise, every questions will be addressed by Amit Jeswani, and whoever have raised the question, they will receive the answers from Amit Jeswani within a week's time. Hope, Amit, you will support me on this.
Absolutely, Pallabji, we will.
Yeah, I'll move on to the first question. Many of the investors, as a perspective, whether Stallion Asset is run by only Amit Jeswani. So that's a perception in the market. Would like to know about your team, your background, your strength, and so on.
We've got 18 people in our team. So our team is very strong. Most people have been with us for a very long time, since inception. They've seen us grow. They've all grown to us together. We have 18 people in the team. They're all smarter than me. I can tell you that. So I'm basically the most weakest one in the team. So I can tell you one thing. So about my team, my co-fund manager is the main fund manager is Juhi Shah. She's been with Stallion for 6 years. She's a master's from NMIMS, we've got Arpit Shah, who's been with us for 4 years, who's also the co-fund manager. He's also doing, he's finished his 2 levels of CFA, and he's also done his master's. We've got Bezat Kalantri, who's heads our business side, who's basically the one who's speaking to everyone. He has done his CFA level 1, and he's studied from London School of Economics. We've got Yash, who's a consultant, business consultant. He's also been the founding director of Stallion, he's finished his master's from ISP. He's a lawyer and a CFA. He's been with us as a founding director, and I know him for the last 10 years, 15 years. We've done business together. We've got Rohit. So I've got a lot of people in the team. So I can keep saying but typically what we look out for in talent is poor, hungry, and greedy. So they need to think they're poor. They need to be very, very, very hungry, and they need to scale with us. So those are the kind of people who typically be higher. But it's not me alone. I can tell you, if I move my office this way, this is my office, and there are a lot of people sitting here, and that is
So it is an 18-member team, right? Wonderful. And on curious note, I believe when I visited your office, it was fascinating to see that most of them, or I think everyone, are less than 35, if I'm not wrong.
Yeah. Everyone's less, except our accounts team. Yeah, everyone's less than 35.
So it's a young and dynamic team. So it is not a single man show, right? So thanks for confirming that for our audience. So I'll move on to next question, Mr. Amit. So what is your view on investing in popular sector PSUs, specifically on the bank side in the current scenario?
No, I will never invest. I never say never in markets, but I don't think so. We will invest in Stallion in PSUs. And lending to 100% will not invest in, very difficult for me to invest in PSU banks. See, in banking, the last 2-3 installments is your profit. What you have paid, like your 40 installments, that is his cost of capital, right? Only the last 3 installments are his profit. And if you cannot get that, you will never win in the banking space in India. A very difficult space. PSUs, in my opinion, very tough for PSUs to make money. And they do mostly wholesale kind of lending. No one ever in India has made money in the wholesale lending in India. So I don't see a reason why we would. And they're not even hyperscalers. They will lose market share. They need to gain market share. We have a technological advantage. They are not the ones, in my opinion, that will scale up.
Fine, Amit. So as we know, Stallion is so dynamic in investing. Had you rewarded yourself from the changes made during pandemic fall to till date, as we reached exactly 1 year since full lockdown and steep corrections in the market?
Have I rewarded myself?
Yeah.
No. We have done well, but no rewards for myself. It's the same old thing. I wear exactly the same clothes, same everything. There's nothing that we have rewarded myself. My team would be rewarded very heavily this year for the beautiful performance they've delivered for us, for our customers.
But broadly, what are all the changes and what are all your learnings, during those during those period?
Actually, we did well because we got into a few hyperscalers, Ballavji. And one thing is there that we've been through many crises. We went through 2018 crisis. Those who would remember 2013 crisis was a very tough crisis for majority of people. Of course, then you had Modi rally coming in. 2016 crisis was there where the China crisis happened when the Nifty corrected 20-30%. So I've seen 2008 myself with a large percentage of my family's money invested, my own money invested. So we've seen 2008 very, very closely with leveraged positions. It makes us a better risk manager. So every time we see a crisis and we come out of the crisis, it makes us better risk managers. So this crisis as well, we were probably one of the fastest ones to hit new highs. So that is very important. And that's where you get your conviction from, that you make new highs very fast. Especially in a down market. So I think in June or July itself, we made a new high. If I'm not wrong, I'll have to check again, but we were very fast in making new highs. Well beyond, because we fell less, so we could basically, as soon as the market started going up, we were probably the ones that made new highs.
Fine, I'll take the last question. So to what category of investors' risk profile Stallion Asset Core Fund portfolio is suitable? And what is a minimum time horizon you recommend for a new investor with Stallion Asset PMS?
See, our beta is equivalent to, my risk is equivalent to any large size. Like, in fact, I was looking at mutual fund betas, they're higher than our betas, even in our 2.5 year period or my 7 year period, 8 year period of my RA desk. My betas have always been below 1. And that is where our betas would be. So our betas will be lesser than what typically a mutual fund does. Only mature portfolio, mature, consistent, mature business kind of portfolio, beta is 0.79. My beta is 0.82. So we've not increased our beta. We have measures to decrease beta, something like a NASDAQ 100 is part of our portfolio. NASDAQ is an ETF. It's a negative beta ETF. So we use a lot of measures to make sure our betas are lower. Let's take an example. If Nifty falls, if NASDAQ falls 10%, odds are that Nifty will also fall 10%. But the USD INR will move up 5%, right? So NASDAQ, so my Indian returns will be minus 5%. So there are many things we do to make sure our portfolio betas are well in control, and in majority of times even lower than only mature, only company portfolio.
Fine, Amit. And there are plethora of questions which have been unanswered. And as I promised, we'll be reverting with the answer within a week's time. So with that note, thanks, Amit, for joining us today. And it was a wonderful session, and hope participants enjoyed thoroughly.
Thank you, Pallavji. Thank you, everyone who joined this session. I would be reverting back to your questions. Thank you so much again, PMS Bazaar, and everyone who joined this conversation. Thank you so much. Bye-bye.